Turning now to how home buyers can navigate volatility in mortgage rates. We have Jeff Taylor, the founder of Mphasis Digital Risk. Jeff, it's good to see you. So in terms of just sort of navigating this mortgage volatility, Jeff, you say the best case scenario, you argue here, lower mortgage rates without a price spike. Now, that's the best case scenario, Jeff. How realistic is that?
So if you look at right now, as we head into the home buying season, right? Rates are right around 6%, as we just said. It kind of dipped below 6 last week, and you have an average median home price around $400,000. This is pretty affordable. Actually, if you look at January from an affordability perspective, it was the best month that we had in 4 years. We're looking at median income and a median home price of around $400,000. People were spending 27.8% of their income on housing. So we're in a pretty good spot right now as we head into the spring season.
So best case scenario, what about the worst case scenario, Jeff? What are the real risks I should have on the radar?
It's a great question, right? So the big risk I would see right now, let's say all of a sudden we had a drop from 6 to 5 overnight, right? So all of a sudden now that's going to really hurt affordability. And also what we're going to start to see is prices rise. So that would be something that would be sort of like your quick volatile, we're going to lose on affordability, and then all of a sudden prices would start to go up. And I don't foresee that happening in the near future.
Are home buyers, Jeff, are they in some sense hostage to the bond market? Does this come down to listen to how we all think about the inflation trajectory from here, how we all think about Fed credibility?
I wouldn't say they're hostage, but look, it definitely moves right now. When we have inflammatory concerns, obviously, mortgage bond market is going to rise. And again, we've been in an area for the last 4 years where we've been over 6%. So I think, look, with the geopolitical issues going on right now, as those start to stabilize down, I think the mortgage market and the bond market will also start to stabilize with it. So in the long term, while we're seeing some spikes kind of right now as we got back to 6th and 8th or what have you, I think for the long term, we're in good shape.
So Jeff, let's switch to another hot topic, which are these sort of AI disruption fears. To the extent, Jeff, that you saw material, meaningful job losses in sort of white-collar jobs, where across the country, Jeff, would that show up first?
Great question, right? So you're going to be in your tech centers. We're going to be San Francisco, Seattle, Austin. Those are going to be the cities where we come in there and potentially hit the hardest immediately. And what you would see there is, let's say that people all of a sudden did have some job losses. You would see maybe others. You obviously could potentially see a 5-10% decrease in home values over a period of time. And what that ultimately would do, considering how high those markets are already, that could allow for some other people to potentially come in and enter the housing market that have been sitting on the sidelines saying, I want to get in, but it's just too expensive. So that's probably the scenario you could see there.
Let's say a friend came to you, Jeff, and they say, listen, I'm concerned here, Jeff, that my job, my sector, my industry could be an AI disruption victim. Would you tell them, well, maybe you want to hold off here, you want to be more cautious, more conservative before pulling the trigger on buying a home?
It's a great question, right? And that's really individualized depending upon how nervous the person truly is. But if I take that statement and go across the housing market, right? Right now we have the highest home equity we ever had in U.S. history. We have 11 trillion tappable, still having 20, and if we tap all of that at once, we'd have 20% left over. So my point to saying that is, it's never a bad time to get into the housing market. If you're concerned about your job, be smart. If somebody has told you, listen, we think what you're doing today is going to be automated, you're not going to have a job, I would hold. However, whenever you have great change, right, there's always opportunities that come from some opportunities that are lost. That's been the story throughout our history. So again, I would very much look at it on an individual basis. But when you look at how much home equity and how much wealth has been built in the housing market since the 2009-2010 financial crisis, owning a home is a really, really good thing.
Jeff, final question, final topic. The White House has made it clear, Jeff, they don't want big investors buying those single-family homes. Did you look at that, Jeff, and say, okay, that's, is that pure politics, Jeff, or no, that could have a material impact on our housing market?
Look, it could have a material impact. Right now, devil's in the details, how they define actually buying so many houses. But when you're looking at large corporations buying hundreds of houses, right, and then renting them out, what does that do in certain areas? It's going to always keep the supply very tight, and it's going to potentially keep it more expensive. If I'm an individual looking to buy a house if you don't have big corporations buying so many houses, you might be able to get a better deal. However, I do think that corporations buying single-family houses in the housing market has done a lot to stabilize the housing market, especially coming out of 2000 and 2010 financial crisis. So again, like everything else, with the right balance and the right mix, it can be a good thing.
Jeff, great to have you on the show. Thank you.
Thank you.